The Reserve Bank is about to hand down its decision on interest rates. Most economists expect that they'll be left on hold at 4.35%, but the bank may also hike rates. Some economists are thinking and that rate hikes might be back in the agenda. Well, with more, Alicia Barry is with me in the studio. Hi there, Alicia. So is anybody expecting a move?
Well, there are some outliers. I mean, look, when you look at the poll by Refinitiv, it has pretty much a broad-based expectation among economists that rates will be on hold. But when it comes to market bets, there's a 15% chance of a rate hike this month, being in about 22 seconds, versus an 85% chance that rates will be on hold. Of course, as you say, though, Roz, after those strong inflation numbers for the March quarter, rate hikes were put back on the agenda, and certainly a number of economists started to scale back their expectations as to when interest rates would be cut. The decision has just dropped, and as we were expecting, rates are on hold at 4.35% for the month of May, where they have been since November 2023. So this doesn't come as a surprise. It's what the majority of people were expecting, although that outside chance of a rate hike would have had some traders having bets on that. So we're seeing the Australian dollar drop a little bit. When it comes to what the RBA is thinking, I will have a look at the statement shortly, but we do have an economist standing by with us, Warren Hogan, who is the Chief Economic Advisor at Judo Bank and one of the people who has made headlines recently with a bold call of 3 rate rises as a potential move from the RBA. So Warren Hogan, thank you for your time. When it comes to those 3 rate rises that you're forecasting, when would we see the first one? I mean, there are a number of people who would have high cash balances who are hoping that you're right, and a number of people who have very big debt burdens, namely mortgages, that are hoping that you're wrong.
Yeah, and look, I'm sort of hoping I'm wrong too, but all my analysis and all my sort of processes are telling us that this 4.35% cash rate, which the Reserve Bank Board's decided to leave as is today, may not be the right level to ensure inflation comes all the way down. And indeed, I think just a brief reading of their statement suggests they're sort of thinking that, in that their language is toughened up a bit. They're saying inflation is going to be very slow to get down. Their patience is being tested, and there are upside risks to inflation. So there's a bit of language there that suggests that they're sort of moving towards a rate hike, but I wouldn't expect to see it until maybe August, if indeed the economy proves to be resilient enough and inflation sticky enough to justify it.
And it's interesting that that language there is back on the table because, of course, we saw in the minutes of the March meeting that the board didn't actively consider a rate rise in that March deliberation. So it looks like that inflation number has really changed their thinking.
Yeah, it does look that way, and it should, because it was genuinely higher than expected. And although the headline number was only sort of 0.2 above their forecast, or what we imply from their forecast, the detail wasn't good. It's showing that domestic inflation is, well, potentially even picking up a bit this year, but at the very least remaining stubbornly high at probably closer to 4.5% or even 5% rather than the headline 3.6%. And of course, this is what matters to them rather than the headline. And it's only showing the slightest downtrend, and it is still well above their target. So, you know, it's all about making sure that we don't get ourselves into more problems with inflation down the track. That is, if the economy picked up again next year and inflation started to accelerate, they might have to raise interest rates a full percentage point or more, and that would be a disaster. So I think one of the things that's often lost on this conversation is the RBA is mitigating risk as well as trying to manage the economy right now.
And I mean, perhaps this meeting note attached to the decision today might add some weight to your argument. What probability do you attach to your argument that we might see 3 rate rises?
Look, I think, you know, whether it's 2 or 3, I think if they're going to move, it'll probably be at least 2. The only reason I have 3 in there is because every other country that has a similar economy to ours, they already have their interest rate above 5. And the RBA was sort of hoping that all of our variable mortgages out there would mean that our economy was more sensitive and that they wouldn't have to raise rates as much as these other economies. Well, 2 things have happened this year. One is these other economies are having to keep their rates higher for longer without much evidence that they'll be cutting rates anytime soon. And of course, our economy, while soft, particularly consumer spending, has not been derailed by these rate hikes. So, look, I think it is 50-50. I'm not saying it's a done deal by any stretch of the imagination, but given that the conversation was all about the timing of rate cuts as if that was the done deal, I thought it's important that people understand that there are two-way risks to interest rates, and there is a chance they may have to go up again.
Well, that is the language that the RBA is using, of course, today, saying the path of interest rates will best ensure inflation returns to target in a reasonable time frame remains uncertain. It's not dissimilar to the last meeting in March, and the board is not ruling in anything or out. I mean, when it comes to the economy, we of course have seen that hotter than expected March quarter inflation number, but we've also seen below trend GDP and retail sales, which are really in the doldrums. How do we square those two things?
Yeah, look, the economy is operating at or beyond its capacity, which actually means it's very hard for it to grow. So I am looking at the fact that there's still a lot of jobs being created, and that business activity and business investment is still pretty solid. It's actually above trend. The soft patch in the economy all through last year was the pressure brought to bear on Australian consumers because of not just higher interest rates, but the inflation and also, importantly, higher income taxes. They all squeezed household incomes, and that caused the consumption to slow. Well, this year we're going to see that process reverse with no rate hikes, or only one in this financial year, and of course the tax cuts coming, and employment still growing, wages at about 4%. All of that tells us that incomes are going to be a little better and people might start spending. No evidence of that yet. Those retail sales figures, which we got an update on today, are still very soft and showing consumers are very cautious. But you know, the underlying trajectory for employment, I think, is the thing that gives me some concern that consumers may start to spend again, and that inflation does not come down.
It's not a nice thing to hear, though, if you're watching this, that the idea that the unemployment rate must rise in order for the RBA to cut rates. I mean, you could be the one losing your job.
Yeah, look, and I think it's also the context there. I think what the RBA is saying, and I think what will happen is that we're not going to actually see a decline in employment in the economy. The unemployment rate will rise because of this strong population growth, and that eventually, because it's not happening yet, eventually we just won't be able to generate enough jobs for all the people coming into the workforce. And so they're actually trying to preserve the employment gains, not see sort of big job losses. And that seems achievable. In fact, if anything, the real surprise has been how many jobs we've created in Australia this year. And again, I get back to the point I made before is if we let inflation get away from us and they end up having to raise rates a lot more, and this is what happened in the 1980s, of course, then we will get to a situation where we have big job losses and business failures. And I think that's a scenario we have to mitigate and not even tolerate going down that path at all. And if that means taking out some insurance now with a slightly higher interest rate, I think it's worth taking. Obviously, people have a different opinion to me on that, and the RBA is the one who's got to make the judgment.
And Warren Hogan, just finally, the statement of monetary policy is, of course, out as well. And just glancing at it, the RBA is sticking to its previous forecast that inflation will return to its 2 to 3% target before the end of 2025. I mean, can it just do that by keeping interest rates higher for longer and not raising them?
Look, there is a chance for sure. I think that's still the desired scenario on the part of the RBA, the government, and I think most of us in the community. It really is going to come down to how the data plays out, i.e. how the economy plays out over the next few months. But at the moment, the RBA is sticking to the forecast and therefore the plan that they've had in place for the last few months. And they have to, because if they change that too much, then the question will be asked, well, why didn't you hike rates? So I wouldn't have expected them to change their forecast too much without any move on rates, and that's what they've done.
And just a final question. What's the next flashpoint? Is it the second quarter inflation figures?
Look, I think that's going to be the key. And if they are high, like we saw in the first quarter, and also if the growth numbers and the employment numbers are solid over the next few months, then I think that's what triggers an August move. But yes, it's those Q2 CPI figures at the end of July that are absolutely critical, I think, for interest rates.
Warren Hogan, appreciate your time. Thank you so much for making it for us.
Thanks, Alicia. Thanks for having me on the show.
So, Roz, it does seem from the RBA's commentary around the interest rates decision today that even in spite of those very much stronger than expected inflation figures in the March quarter, it is sticking to the script at the moment while calling them out, but not ruling anything in or out, and will rely upon the evolving data as it assesses the state of the economy.
Yeah, and just quickly, has the Aussie dollar reacted?
Yeah, so we were seeing some movement when it came to the markets and the dollar as a result of the cash rate remaining on hold at 4.35%. It has fallen a little bit, about 1/3%. It's holding just at 66 US cents. It was at 66.2 heading into this decision.
Okay. Alicia, thank you.